What's up guys, Jake here, welcome back. In today's video, we're going to do another update to my brokerage account challenge because yesterday I lost a lot of money. In the event you haven't seen any of my prior videos for this challenge, I will include the playlist down below so you can catch up. But the gist of it is, it's me versus a total stock market index fund. I started this challenge on January 1st with $25,000, and I'm trying to double my account balance by the end of the year, or at the very least, outperform a simple low-cost total stock market index fund. My positions in this video are current as of April 22nd. This is trading day 76 of 252. And the S&P, the market, was down 0.92% today. And we are down 1.21% from the S&P's all-time high. And of course, finance YouTubers have to make their panic videos about how the markets are crashing. President Biden crashed the markets. It's all going down. Sell everything. Market crash is coming. If you can't handle a 0.92% volatility or drop in the markets, then active trading is not for you. If less than a 1% drop spooks you out to the point where you start panic selling your stocks, just don't even do this. Stop watching this video, put everything you have in an index fund, don't look at it, check it in 20 years. And because most of my positions are in options, I'm going to see a much more dramatic drop. If you want to trade options and specifically buy options, then you're going to see huge swings. And yesterday was a perfect example. So my account balance with Charles Schwab was down 6.33%. Because I'm leveraged, if the S&P goes down 0.92%, my account is going to go down 6.33%. So in my Schwab account, I was down $2,900. If you're curious, I also trade in my Fidelity account. Everything was red yesterday. And in my Fidelity account, I was down $4,100. Add those together, and I was down yesterday just over $7,000. However, I did not sell anything. Look at this hand. Do you see me panicking? There was nothing substantial yesterday that would indicate that a crash or a sell-off bigger than what it was is going to happen. So I am still up 71.7% in my Schwab account, and the total stock market index fund is up 11.8%. So I'm not concerned about this. I think that it'll all come back in the next week at least. And why was there so much volatility in the markets this week? And it kind of started earlier this week when Netflix gave its earnings report, and it's showing that it's slowing down. Now, Netflix is still growing, it's still profitable, it's still a great company, but why did it lose 10% of its market cap? And the reason why is because look at this PE ratio of 61. It was probably higher before this occurred. And when investors look at the mega cap growth companies that are rapidly expanding, they're factoring in that tremendous growth. However, with Netflix, they're still growing, but they're showing a slowed down growth rate, especially in international markets. Because they have so much competition from HBO Max and Paramount Plus and Disney Plus and all these other streaming services, Netflix doesn't have the monopoly on home entertainment anymore. So this stock did crash, a greater than 10% drop in a day, and it's not recovering. And this kind of led to a sell-off in general of the NASDAQ. So I'm holding call contracts on Adobe, Apple, and Facebook, and a sell-off in Netflix definitely did not help that sector. And the big news story from yesterday is President Biden eyeing tax rates as high as 43% for long-term capital gains. What does this mean? So if you hold a stock or a security longer than a year and you sell it, you're then subject to your long-term capital gains tax rate, not your short-term, which is your marginal tax rate, which is much higher. So there's an incentive for market stability if people are willing to hold their positions longer than a year. The markets in general like this. I don't know what the final details of Biden's plan is, but right now there's a 0%, 15%, 20% bracket. I guess there would be a 43% bracket down here, and anything, if your combined income is over $1 million, you'd then be taxed at this 43% bracket. Now, this is with marginal tax brackets or these capital gains tax brackets, it's not what you're paying total. So first of all, if you're not a millionaire, this doesn't affect you. But if you are a millionaire, let's say you were to sell exactly $1,001 worth of stock, and that was your taxable income amounts, you'd be paying 43% on $1 that went over $1 million, and then you'd be paying 20% everything between 441 and 999, 15.0. So your effective long-term capital tax rate would be closer to 20%, even if you're selling more than $1 million. Let's say you sell $2 million. Just averaging it out, you'd be closer to a 30%. The more you make, the more you sell, the richer you are, the more it goes up. That is our, in general, progressive tax system. However, this is irrelevant because everyone in Congress is a millionaire. They all trade on insider information. It's legal when you're a member of Congress, and there's no way this is going to pass. So this is a blip. But why, as soon as this information went public, was there a huge sell-off in the S&P? Why was there the drop? And when the market goes down, think about this logically. There's only two ways for the market to go down. One, people who own stock sell their stock, and two, people who don't own stock short sell. They borrow stock and then sell it to drive down the price of the market. So short sellers saw this as an opportunity on news to spook the market, and the shorters immediately jumped in and started shorting stocks. And they only make money because they have to buy back and close their positions eventually. They only make money when normal people panic and then sell their stock. So when a newsworthy event like this occurs, just think about it logically. Think about it like, how does this actually affect the market today? And it doesn't. If the long-term capital gains tax rate were to go up, this wouldn't take effect until January 1st of 2022, and you wouldn't be paying these taxes until April of 2023. How does paying taxes in April of 2023 affect the markets today? It doesn't. So anybody selling, to lock in their long-term capital gains tax rate today to pay it next April, nothing about this is substantial. It doesn't make any sense for this to drive the market down. Yes, in the short term, people price in effects that will occur in the distant future, but anybody selling is just going to put their money right back into the market because people are making money in the market right now. I'm going to be honest with you guys and tell you exactly what will bring the market down, what actually will cause the stock market to crash, and there are two things. The first one is what interest rate the Federal Reserve charges commercial banks for borrowing money. So this is the Fed's this is the Fed's interest rate. So it was as high, it was over 5% prior to the 2008 collapse. It then went down to zero as it looked like we were recovering. It started going up, and then we had a pandemic, and it's back at zero. So the Fed interest rate is what commercial banks borrow from the Fed. And this is basically zero now. If this starts going up, that will cause the money supply in the economy to finally contract. That would cause the stock market to go down. The other thing that would cause the market to go down is the bond yield. What percent interest rate can you earn by owning government bonds? And you can see in '94, this was as high as 8%. That's pretty good. And this gray line is what you earn from the dividend yield of an S&P 500 index fund. So when the bond yield is below what you earn in dividends from just being in the market, rich people don't want to buy bonds. They want to be in the market because they're earning more money just from dividends alone. So as soon as the Treasury bond yield gets back above what you can earn from dividends for the S&P, then rich people are going to start selling off their stocks in order to start buying bonds again. For rich people, they just want to beat inflation. They don't want their money losing value because of inflation being between 1, 2, 3, maybe higher in the short term. So as soon as Treasury yields start going up, then I think we're actually going to see a sell-off as wealthy people leave the market and start buying Treasury bonds again. But none of that is happening anytime soon, so I'm not worried at all about this market. I think what I lost this week, I will get back in the next week. These are my account positions as of my last update video on April 15th. You can pause the video if you want to see specifically what numbers I had. And these are my positions as of Thursday, April 22nd. And yeah, for the day change, everything was red. Everything was down yesterday. But once again, don't panic sell. It'll come back. And since my last update video, I actually haven't sold anything, and I want to continue talking about earnings reports because so many of my positions I think will be affected by their earnings. And when I show my 14 or 15 positions, I keep saying when the trend halts, I want to sell it or I have a price target. And how do you know? How do you know when the trend has halted? I don't think I've done a good job of explaining that. So we'll talk about that. And we're going to talk about that in relation to all of these upcoming earnings dates. I'm currently filming this video during the day on Friday. The market is open and you can see everything is already going back up. However, let's go over to Yahoo Finance and let's just check out the stock charts of all of my positions. And I'm just going to talk about exactly what I'm thinking and what I'm seeing. So let's look at the stock chart for Adobe first, because I think this is my largest position. This is a very expensive stock and a very expensive call contract. So when we look at the stock chart, the magic number that Adobe had to break through was 500. You can see this was forming a resistance line where it had bounced off 500 several times. So as soon as it broke 500, I saw that as a buy. However, it went up to 525, another round number. It then bounced off. Thankfully, it's back up today. But when would I say that this trend has halted and it's not worth holding this call contract anymore? You'll notice that the 20-day moving average hasn't caught up to it. A good rule of thumb, not always, but good rule of thumb is if the share price drops below the 20-day moving average, not on any news did not drive it, then it's showing a weakness where there aren't as many buyers willing to continue the uptrend. So as long as, even if it goes down 3 consecutive days, I'm not worried about this call contract and the uptrend halting until it gets below that 20-day moving average. Next stock let's check out is Facebook, and Facebook actually does have me worried because look at this. It punched through this resistance line that had been forming around 290, 300. It got as high as 313 and I was saying, hey, Facebook is well rested. It's due for a breakout. It's then had 1, 2, 3, 4, 5 consecutive red days, went up, and then 1, 2, 3, 4 consecutive red days. It's up today, thankfully. However, it's dipped below that 20-day moving average. So my thinking is the uptrend halted? Is this stock just going to start trading sideways? And I actually don't think so. April 28th is Facebook's earnings report date. And I actually think, once again, Facebook is due for a breakout. I think they're going to report monster numbers in advertising for the first quarter. So I actually think when they report on April 28th, the stock is going to shoot up huge, maybe 5% or greater. And then that will start a new uptrend and take it to a nice round number, hopefully 350. The next stock is Apple, and Apple is, in my opinion, kind of the opposite of Facebook. So it's been in an uptrend. I think I bought a call contract when it got as low as 120. It went up to 130, and it's basically been trading sideways in this 131, 135 range, which is good. It's being very predictable. Now, Apple's all-time high is close to 140. Is it going to get back to 140? And I don't think it is. I've looked at Apple's fundamentals, and compared to how they've been valued in the past, they are overvalued right now. So I actually think the opposite for Apple is going to occur. Once again, they report their earnings on April 28th, and I actually think it's going to keep going up until April 28th, and then on earnings, which will be good news, there will be a sell-off. I could be wrong, but I feel like the pattern that I'm seeing, especially in the last 4 or 5 months, is that stocks that have run up huge on earnings sell off, and stocks that are doing, companies that are doing well, that are trading sideways on earnings, shoot up. Just a pattern. I could be wrong. So I think that I want to hold this Apple call contract until the day before, April 27th, and then I want to get rid of it because I think it's going to drop. Next stock is Lockheed Martin, and I don't know what's going on with Lockheed Martin. I was up huge on this call contract. I think I bought somewhere around here. It shot up to 391. I was pretty convinced it was going to 400. It's now gone down to 375. It's below the 20-day moving average. So I'm going to give this stock until Tuesday of next week to get its act together. If it doesn't get back above this 20-day moving average, if it just starts trading sideways, then I think I have to just sell this for whatever I can get for it, because this drop from 391 to 375 is not good news. Next stock is Northrop Grumman, and once again, defense contractor. It hit 346. I was hoping it would get to at least 350. It's dropped to 340. Once again, it hasn't touched or gone below the 20-day moving average, so I'm not too worried. Hopefully, once again, next week at some point when the other defense contractors reports, this will be good. So Lockheed Martin reported on April 20th, and once again, good news, but there was a sell-off. Northrop Grumman reports on April 29th. So I'm thinking maybe if it goes back up, if it starts trending up again, I do want to get rid of this on April 28th, a day before. Next stock is Huntington Ingalls, and Huntington Ingalls was in such a nice uptrend, and it basically traded sideways for almost a month. So it kind of halted on March 29th, and by April 23rd, it's dipped below its 20-day. I thought this would go much higher. When you look at their stock chart, this was as high as 277 before the pandemic, and now it's struggling to get to 210, 220. I thought this would make it to 240 at least. I don't see this falling lower because it was such a well-rested stock that had been bottomed out for so long, so we'll see what it does. Next company is General Dynamics, and once again, a defense contractor. It's been trading sideways since the end of March, not good, but it also hasn't gone below or touched its 20-day moving average. So this could continue trending up. Next, let's do Costco, and I love Costco, but let's be honest, I think they're a little overvalued at the moment. They're so close to getting back to their all-time high of 390. I'm just being greedy at this point. I really probably should sell Costco. They don't report earnings until a month from now, May 27th, so I think I'm going to hold on to this until it gets 380. You'll notice there was a sell-off when it hit 380 at this point. It's at 374. So I need to stop being greedy with this stock. I'm getting lucky here. So I think if it gets above 375, I probably should take some profit and sell this. Next up is Home Depot, and this was a very well-rested stock that's currently in a breakout. I think there's a huge home improvement, home building, home remodeling boom happening right now, and Home Depot is profiting greatly. It hasn't, once again, touched its 20-day moving average, so I think Home Depot is still doing good. They don't report until May 18th, so I don't think that matters. Dollar General, I really like their fundamentals, but look at this. They 1, 2, 3 consecutive red days. However, if it's in a new breakout, it just got ahead of itself. The 20-day moving average is coming up to meet it. As long as it doesn't fall below that, I still think the uptrend is continuing. Next up is Walmart, WMT, and Walmart, I should probably get rid of this. This halted on early April, and it's been trading almost perfectly sideways for 3 weeks. So I feel like that's an indication. And Walmart, I bought it because it had dipped so low, and it is a little overvalued in my opinion from just where it's been valued in the past. I was hoping that it would get to at least 145, 150 would be back to the all-time high, but if it keeps trading sideways, once again, as soon as it touches that 20-day moving average or gets below it, I think I should sell this. Next up is Allstate, and this is a beautiful stock. Wow. Perfect uptrend, very nice, consistent, predictable. I don't see any reason to sell this call contract as long as the uptrend continues. Next is Bank of America stock, and Bank of America just had its earnings report, I think a week ago, and yeah, there was a sell-off. However, it's going back up again. Their earnings were good. It was good news, but once again, when a stock shoots up so much, there just seems to be a pullback even when the earnings reports is good. Wells Fargo is the opposite though. Wells Fargo, it's in an uptrend, but their stock is so beat down from where they were pre-pandemic. Let's look at Wells Fargo. It was at $54 prior to the pandemic, and then nobody wanted to own or buy this stock. It got as low as $21, and it's up 100% since November. I definitely think this stock should make it back to 50. The earnings report that they gave didn't show it was that bad. I think there was so much pessimism and the bar was so low for Wells Fargo that they met it, and investors are happy. The stock is going up. So there you have it, guys. That's kind of my thinking when I check these stock graphs. I don't need to check the fundamentals because those don't really change much day to day. But I do briefly pop into these stock charts every day. It takes me 15 minutes and it's kind of fun. And I just look at them and I try and think, what's happening here? What's likely to happen? The more you just stare at them, the more you start seeing these trends, and you can, once again, not predict the future, but you can make educated guesses about what's going to happen with these stocks. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, if you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.